The information provided in this video is for educational purposes only and is not intended as financial, investment, or trading advice. All trading involves substantial risk of loss and is not suitable for every investor. The content of this presentation reflects the opinions of the speaker and should not be considered a recommendation to buy or sell any financial instrument. Please conduct your own thorough research and consult with a qualified financial professional before making any investment decisions. Past performance is not indicative of future results. What if I told you that the single biggest difference between the top 1% of American Forex traders and everyone else has almost nothing to do with the charts? It has nothing to do with a secret indicator, a magic algorithm, or some hidden signal from Wall Street. It's something far more fundamental, something that's built, not bought. It's a set of meticulously crafted habits. Think about it. We've all been there. Staring at the screen, the flickering lights of the euro to US dollar chart dancing in your eyes at 2 in the morning. You see a pattern you think you recognize. Your heart starts pounding. Is this the one? The trade that makes back last week's losses? You click the button. For a moment it goes your way. The rush of validation is incredible. Then, in a heartbeat, the market turns. A single red candle erases your gains and then some. Your stomach drops. You feel that familiar cocktail of frustration, anger, and a little bit of shame. You tell yourself, I just need a better strategy. So you go back online, searching for the next holy grail system, and the cycle repeats. That cycle is the graveyard of trading accounts across the country. But a small group of traders, from quiet home offices in suburban Ohio to high-tech setups in Miami, have broken free. They operate on a completely different level. They don't ride the emotional roller coaster because they've replaced emotion with process. They've replaced hope with statistics. They've replaced gambling with a series of deeply ingrained, non-negotiable habits. And over the next 10 parts of this series, we are going to dissect every single one of them. We're going to pull back the curtain and give you the operational blueprint, the daily, weekly, and monthly rituals that form the foundation of consistent, long-term trading potential. This isn't about a get-rich-quick scheme. This is about building a career-level skill set, one habit at a time. So let's start with the cornerstone, the one habit that every other habit is built upon. If you get this one wrong, nothing else matters. It's the habit of treating your trading like a business. This sounds simple, maybe even a little cliche, but almost no one actually does it. The average person approaches trading like a trip to Las Vegas. They fund an account with what they consider risk capital, which is just a fancy term for money they are emotionally prepared to lose. They're looking for excitement, for a quick hit, for a good story to tell. A business owner doesn't think like that. A business owner is not looking for excitement. They're looking for profit. They're obsessed with process, efficiency, and managing risk. Let me ask you this. Would you open a coffee shop in your town without a business plan? Without knowing your startup costs, your target customer, your pricing strategy, your suppliers, and your marketing plan? Of course not. You'd be laughed out of the bank. Yet, thousands of people will fund a trading account with $5,000, $10,000, even $50,000 with little more than a vague idea of buy low, sell high. That's not a business. That's a lottery ticket with worse odds. So what does treating trading like a business actually look like in practice? First, it means you have a written trading plan. Not just an idea in your head, a physical or digital document. This is your corporate charter. It details exactly what you trade, when you trade, and how you trade. It defines your edge, your specific, repeatable strategy that historical data suggests has a positive expectancy over a large series of trades. It explicitly states your risk management rules. How much of your capital will you risk on any single trade? 1%? 0.5%? What is your maximum daily loss before you shut down for the day? No questions asked. These aren't suggestions. They are the bylaws of your company. A business that ignores its own rules is a business that is destined to fail. Second, a business owner understands and manages expenses. In trading, your primary unavoidable business expense is losses. The gambler sees a loss as a personal failure. The business owner sees a loss as a cost of doing business, a predictable and manageable expense, just like rent or inventory. When you reframe losses this way, it completely changes your psychology. A loss is no longer an emotional gut punch. It's a data point. It's feedback. Was it a good loss, meaning you followed your plan perfectly and the trade just didn't work out? Or was it a bad loss, meaning you broke your rules out of fear or greed? The business owner analyzes these expenses to improve their process. The gambler just gets angry and tries to win it back, which is like a shop owner setting fire to their own inventory out of frustration. Third, a business owner invests in their company. They buy the best equipment they can afford, they invest in training for their staff, and they constantly look for ways to innovate. For a trader, this means investing in the right tools. That might be premium charting software, a reliable data feed, or a powerful computer that doesn't lag at a critical moment. But far more importantly, it means investing in yourself. That's your education. It's not about buying 100 different courses. It's about finding a methodology that resonates with you and mastering it. It's about reading books on trading psychology because you are the CEO, the head of sales, and the entire workforce of your trading business. If the person running the show is prone to panic, indiscipline, and emotional decision-making, the business is doomed no matter how good the strategy is on paper. Finally, a true business owner conducts regular performance reviews. They don't just look at the bottom line profit or loss at the end of the month. They dive deep into the analytics. What was our customer acquisition cost? What's our profit margin on each product line? For a trader, this is the habit of journaling and reviewing every single trade. At the end of every week, you must sit down and review your performance. Not just your P&L, but your execution. How well did you adhere to your business plan? Where did you deviate? Why did you deviate? Was it fear? Greed? Impatience? You have to be the tough but fair boss with yourself. You identify your weaknesses not to beat yourself up, but to create a plan for improvement for the following week. This feedback loop, plan, execute, review, adapt, is the engine of all successful businesses, and it is the absolute lifeblood of a successful trading career. Shifting your mindset from a gambler to a business owner is the most profound change you can make. It's the foundation. It forces you to take this seriously. It instills a level of professionalism and discipline that is simply impossible to maintain when you're just playing the markets. You stop looking for that one magic trade and start focusing on executing your edge flawlessly over hundreds and thousands of trades. You stop focusing on the money and start focusing on the process, knowing that if you perfect the process, the potential outcomes will take care of themselves. This is habit number 1. It's not sexy. It doesn't involve a secret indicator. It's hard work. It requires you to sit down, think, and plan before you ever risk a single dollar. But it is the non-negotiable price of admission to the world of professional trading. Without it, you're just another tourist in the market, and the house always wins against the tourist. But with it, you've laid the first, most critical stone in the foundation of your trading empire. You've become the house. Now, a business plan is essential. But even the world's greatest business plan is utterly useless if the CEO, that's you, lacks the one mental habit that governs every single decision, every click of the mouse, every moment of uncertainty. It's the habit that allows traders to stay calm in chaos and objective under pressure. And that is exactly what we're going to deconstruct next. It's called the habit of detached execution. This isn't about being a robot. It's not about suppressing emotion. It's about building a system so robust, so well-tested, so ingrained in your mind that your emotions become irrelevant to your actions in the market. It's the difference between a gambler pulling a slot machine lever, hoping for a jackpot, and a casino owner who understands the statistical edge of the house over thousands of pulls. The successful trader isn't the gambler. They are the house. Let me tell you about a trader I know. We'll call him Mark. Mark wasn't from Wall Street. He was a software engineer from Austin, Texas, brilliant with code, but a complete mess when it came to trading. In his first year, Mark was the classic emotional trader. He'd get a rush from a winning trade, feeling like a genius, and immediately double down on his next position, convinced he'd found the secret. Of course, that larger trade would often turn against him, and the panic would set in. He'd stare at the red numbers on his screen, his heart pounding, his mind screaming, "It has to turn around. It just has to." He'd move his stop-loss further down, giving the trade more room to breathe, which really meant giving it more room to bleed him dry. He wasn't trading a plan. He was trading his feelings. Hope, greed, fear, and despair were his technical indicators, and they were bankrupting him not just financially but mentally. The breaking point came on a Tuesday afternoon. He was trading the British pound against the dollar after some unexpected news out of the UK. The market went parabolic. He jumped in chasing the move, and in minutes he was up a significant amount. The dopamine hit was intense. He felt invincible. But instead of taking his profit, he held on, dreaming of a life-changing win. Then, just as quickly, the market reversed. The green on his screen turned to a horrifying, flashing red. He froze. He couldn't click the mouse to close the position. It was like his hand was paralyzed by failure. In less than 10 minutes, he lost over a month's salary. He shut his laptop, walked out of his home office, and just sat in his backyard, staring at nothing for hours. That was his rock bottom. It was in that moment of total failure that something shifted. He realized his intelligence, his analytical skills, they meant nothing. His emotions were in the driver's seat, and they were driving him straight off a cliff. So he made a decision. He would stop trading his opinions and start trading a system. He spent the next 6 months not placing a single live trade. Instead, he dedicated himself to building and rigorously backtesting a specific trading strategy. He defined every single variable, what exact chart pattern would trigger an entry, where his stop loss would be placed before he ever entered the trade, and where he would take his profit. No exceptions. No negotiations. He created a simple checklist. Before any trade, he had to tick off every box. Was the moving average crossover present? Yes. Was the RSI in the correct zone? Yes. Was the trade occurring during the London session? Yes. Was his risk limited to exactly 1% of his account? Yes. If even one box was unchecked, he was not allowed to take the trade. Period. When he finally returned to live trading, he was a different person. He wasn't Mark the hopeful gambler anymore. He was Mark the system operator. When a setup appeared and he ticked all the boxes, he placed the trade. He set his stop loss, he set his take profit, and then he walked away from the computer. He went and worked on his software projects. He went to the gym. He trusted the system because he had the data from months of backtesting that proved its statistical edge over time. Some trades won. Some trades lost. But Mark's emotional state didn't ride that roller coaster anymore. A winning trade wasn't a reason to celebrate. It was simply confirmation that the system worked as expected. A losing trade wasn't a personal failure. It was a calculated, acceptable business expense, a data point that was factored into the system's overall profitability. He had achieved detached execution. He had stopped focusing on the outcome of any single trade and started focusing exclusively on the perfection of his process. Over the next 2 years, his account saw a growth trajectory that was steady and consistent, a stark contrast to the wild heart attack-inducing swings of his early days. Mark's story illustrates the 3 pillars of this crucial habit. First is the shift from outcome-based thinking to process-based thinking. Elite performers in any field, from surgeons to fighter pilots to professional athletes, understand this. A pro basketball player shooting a free throw doesn't focus on the ball going in the hoop. They focus on their grip, their elbow alignment, their follow-through. They know if they perfect the process, the outcome will take care of itself over thousands of shots. Trading is no different. Your job isn't to make money on this one trade. Your job is to execute your tested plan flawlessly. The money is simply a byproduct of consistent, disciplined execution. The second pillar is the radical acceptance of uncertainty. As a trader, you are a professional risk manager operating in an environment of incomplete information. You will never know for sure what the market is going to do next. The most successful traders don't try to predict the future. They build systems that account for the fact that the future is unpredictable. They know they will be wrong frequently. Their trading plan is their shield. It's designed to protect them from catastrophic losses when they are inevitably wrong, and allow them to capitalize when they happen to be right. A stop loss isn't a sign of failure. It's a tool of professional risk management. Embracing it is a sign of maturity. The third and final pillar is the externalization of discipline. Willpower is a finite resource. Relying on it to fight off fear and greed in the heat of a volatile market is a losing battle. That's why Mark created his checklist. It was an external tool. It moved the discipline from his mind, which is prone to emotional hijacking, to a physical or digital piece of paper. The plan, the rules, the checklist, these things become your boss. You are just the employee whose only job is to follow the instructions. This removes the burden of in-the-moment decision-making, which is where 90% of trading errors occur. Building this habit of detached execution is not easy. It requires you to unlearn a lifetime of emotional responses. It requires you to find more satisfaction in following your rules perfectly on a losing trade than in breaking your rules on a winning trade. Because a rule-breaking winner reinforces bad habits that will eventually destroy your account, while a rule-following loser reinforces the discipline that forms the bedrock of long-term success. It's a profound mental rewiring. But even with this ironclad mindset, this fortress of psychological discipline, a trader is still vulnerable. Because a perfect mindset executing a flawed system is like a great pilot flying a plane with a broken engine. the crash is inevitable. Your discipline needs something to latch onto, a framework that is mathematically and strategically sound. This brings us to the next core habit, the one that provides the raw materials for your trading system and the cold, hard data needed to build unshakable confidence. It's the practical day-in, day-out grind that separates the dreamers from the earners. And it's the one habit that most aspiring traders skip because, frankly, it's not glamorous. But it is, without a doubt, the true engine of profitability. So what is this unglamorous engine of profitability habit? It's the meticulous, almost obsessive practice of treating every single trade not as a bet, but as a scientific data point. It's the habit of becoming the chief scientist of your own performance. Think about it. A professional athlete spends more time reviewing game film than they do actually playing the game. A world-class surgeon debriefs every single operation, analyzing what went right, what could have been smoother, and what unexpected variables arose. They are relentless students of their own actions. Yet, in the world of trading, countless people will risk thousands of dollars on a position, and if it fails, they just close the chart, feel a pit in their stomach, and try to forget about it. They never perform the autopsy. They never study the film. And so they are doomed to repeat the same mistakes over and over again until their account and their confidence is completely drained. The successful American trader operates on a completely different frequency. They have a system for learning from every click of the mouse. Let me tell you about a trader I know from the Midwest. We'll call him David. David wasn't your typical Wall Street gunslinger. He was an actuary for an insurance company in Des Moines, Iowa. His entire career was built on probabilities, statistics, and understanding risk over massive data sets. When he first started trading Forex, he did what everyone else does. He watched videos, learned a few candlestick patterns, and jumped in. He had some wins which felt incredible, but his losses always seemed to be bigger, more emotionally charged, and ultimately they wiped out all his progress. He was on the classic trader's hamster wheel. One day, after a particularly painful loss, he had an epiphany. He realized he was treating trading like a slot machine in Vegas, but he was treating his day job like a science. At work, he would never make a multi-million-dollar decision for his company based on a gut feeling or a hot tip. He'd demand spreadsheets, historical data, and statistical models. So he asked himself a simple, brutal question. What is my personal trading data? What are my statistics? The answer was he had none. He had a brokerage statement full of wins and losses, but he had zero context. That's when everything changed. He created what he called his trade ledger. It was an Excel spreadsheet at first, but it quickly became his holy text. For every single trade, he didn't just log the entry, exit, and profit or loss. That's amateur level. David logged nearly 20 different data points. He logged the date and time, the currency pair, the session, was it London, New York, or the Asian session? He logged the specific technical setup that triggered his entry. He'd even take a screenshot of the chart and paste it into his notes. He logged the reason why he thought this setup was valid. Was it a breakout? A moving average crossover? A Fibonacci retracement? But here's where he went from being a hobbyist to a professional. He started logging the intangible data. He created a psychological profile for every trade. On a scale of 1 to 5, how confident was he in the setup? Was he feeling patient, or was he feeling anxious to be in a trade? Was he trading his plan? Or was this an impulsive FOMO trade because he saw a big candle moving without him? He even logged what was going on in his life. Did he have a stressful day at work? Did he get into an argument with his spouse? He logged everything. And after every trade closed, he performed a post-mortem. He wrote down what he did right, what he did wrong, and what the market did after he exited. Did he take profit too early? Did he let his stop-loss get hit when he should have given it more room? For 3 solid months, he didn't even focus on making money. He focused solely on populating his trade ledger. His only goal was to collect data on himself. Then, he put on his actuary hat and he ran the numbers. The results were staggering, and they became the foundation of his entire career. He discovered that over 80% of his profits came from just 2 currency pairs: Euro to US dollar and pound sterling to Japanese yen. He was losing money on everything else he touched. He discovered that his win rate on Tuesday and Wednesday mornings during the London-New York overlap was nearly 70%. But on Friday afternoons, it plummeted to below 30%. He discovered that any trade he labeled with a FOMO, or anxiety, score higher than 3 was a statistical loser. His data screamed at him that his biggest losses, without exception, came immediately after a string of 3 small wins. His own data proved he got cocky. He got sloppy. Armed with this information, David didn't need to find a new Holy Grail strategy. He already had one buried in his own results. He just needed to eliminate the noise. He created a simple, rigid set of rules based on his own proven statistics. Rule number 1. Only trade euro to US dollar and pound sterling to Japanese yen. Rule 2. Do not, under any circumstances, place a trade on a Friday afternoon. Rule 3. After 3 consecutive winning trades, you must shut down the platform for at least 1 hour. He wasn't trading the market anymore. He was trading his own personal statistically proven edge. His equity curve, which used to look like a violent mountain range, began to smooth out into a steady, upward-sloping hill. He turned a gamble into a predictable business. This is the habit. It's not just journaling. It's conducting a deep, honest, and continuous analysis of your own behavior. Your trading journal is the single most important book you will ever read about the markets, because it's the only one that's about the main character. You. It's where you stop blaming the market, the news, or your broker, and start taking absolute ownership of your results. So, how does this look in practice? It means every weekend you set aside time, non-negotiable time, to review the week's trades. You're not just glancing at the profit and loss. You are the detective and your trades are the crime scene. You ask the hard questions. Where did I deviate from my plan? Why? Was it fear? Was it greed? What patterns am I seeing in my losing trades? Are they all happening at a certain time of day? Are they all on a certain setup that I'm just not good at reading yet? Conversely, you must analyze your winners with the same intensity. Was this a good trade because I followed my plan perfectly? Or was it a bad trade that I just got lucky on? Understanding why you win is just as critical as understanding why you lose. You need to identify what constitutes a high probability setup for you, based on your data, and then build your entire trading plan around creating the discipline to only take those trades. This process transforms you. You stop being a passenger, tossed around by the whims of the market, and you become the pilot. You have the data, you have the flight plan, and you know which weather conditions to avoid. This habit is the ultimate form of self-coaching. It's the feedback loop that allows for incremental, continuous improvement. Without it, you're just guessing. With it, every single trade, whether it's a win or a loss, becomes a piece of invaluable intelligence. It's the tuition you pay for your market education. The successful trader understands that losing a trade is acceptable, but failing to learn the lesson from that loss is the only unforgivable sin. This deep, data-driven self-assessment is what builds the unshakable, legitimate confidence we talked about earlier. It's not based on hope. It's based on a track record. It's the knowledge that you have a system, you've proven it works for you, and you have the data to back it up. But this introspective, backward-looking analysis is only one half of the equation. It's the defense. The other half is the offense. It's taking all that data, all those lessons learned, and forging them into a weapon. A concrete, forward-looking battle plan that dictates your every move before the market even opens. It's the proactive creation of your rules of engagement. This is your personal constitution. It's the blueprint for your entire trading business. It's the document that separates the professional from the hobbyist, the consistent from the chaotic. This is your trading plan. So many aspiring traders hear that term and their eyes glaze over. They imagine a dusty binder filled with boring rules. But the elite American traders, the ones who survive and thrive for years, not just for a few lucky weeks, they view their trading plan differently. It's not a restriction. It's their liberation. It's the pre-flight checklist a pilot runs through, not because he's a novice, but because he's a professional who leaves nothing to chance. It's the surgical plan a doctor maps out before ever making an incision. It's the ultimate defense against the single greatest threat to your trading capital. You. The market is an arena of overwhelming emotion. When your money is on the line, and prices are flashing red and green, your rational brain can get hijacked. Fear screams at you to close a good trade too early. Greed whispers for you to hold on to a winner just a little longer, right before it reverses and wipes out all your gains. Hope convinces you to move your stop loss on a losing trade, believing it will surely turn around. These impulses are the root cause of account destruction. A trading plan is the psychological fortress you build in the calm, rational hours when the market is closed, designed to protect you from your emotional self when the battle is raging. It's a pre-commitment to rational behavior. You are making decisions for your future self, knowing that your future self will be under pressure and compromised. So what goes into this critical document? What are the pillars that hold up this fortress? The first and perhaps most overlooked component is your why. Your trader's philosophy. Before a single rule about entries or exits, you must define your objective. What is your purpose in the market? Is it to generate supplemental income? Is it to achieve financial independence over the next decade? What is your fundamental belief about how markets work and where your edge comes from? Are you a trend follower who believes in riding momentum? Are you a mean reversion trader who believes prices tend to return to an average? Writing this down isn't just a feel-good exercise. On a day when you take 3 consecutive losses, and your confidence is shattered, rereading your core philosophy reminds you of the bigger picture. It anchors you to your strategy and prevents you from jumping ship to the next shiny object strategy you see online. Next, the plan demands ruthless specialization. The Forex market is vast. You cannot be an expert in the Japanese yen, the Swiss franc, the British pound, and the New Zealand dollar all at once across every time frame. Successful traders are specialists. They are like military special operators, not general infantry. Your plan must explicitly state which currency pairs you will trade and why. Typically, pros stick to the major pairs like the euro/US dollar or the pound/US dollar, because they offer high liquidity and lower transaction costs. They also define their chosen battlefield. The time frame. Are you a scalper, looking for tiny profits over seconds or minutes on the 1-minute chart? Are you a day trader, opening and closing positions within a single session on the 15-minute or 1-hour chart? Or are you a swing trader, holding positions for days or weeks based on the 4-hour or daily chart? Your chosen time frame dictates everything that follows: the types of setups you look for, the amount of risk you take, and the time commitment required. There is no right or wrong answer, but you must choose one or two and commit to mastery. With the what and where defined, we get to the heart of the plan: the specific, objective, and non-negotiable criteria for entering a trade. This is your setup checklist. This section must be so clear that a complete stranger could look at your chart, read your rules, and come to the exact same conclusion as you about whether a valid trade setup is present. Vague rules like "buy when the trend looks strong" are worthless. A professional's plan reads more like a computer algorithm. For example, a valid long setup on the euro to US dollar 4-hour chart requires the following 3 conditions to be met. 1. The price must be trading above the 50-period exponential moving average. 2. The relative strength index must have crossed up from below the 30 level within the last 5 candles. 3. A bullish engulfing candlestick pattern must form at a known horizontal support level. See the difference? There is no room for interpretation. It's a simple yes or no. If all conditions are not met, you do nothing. You sit on your hands. This discipline, this patience to wait for your A+ setup, is a hallmark of every successful trader. Once the setup is confirmed, the plan needs an exact entry trigger. The setup gets you ready, the trigger gets you in. This is the specific event that prompts you to click the buy or sell button. Is it the moment the price breaks above the high of that bullish engulfing candle? Is it when the next candle opens? Defining this removes hesitation and the paralysis by analysis that can cause you to miss a perfect entry. Now for the part that truly separates the pros from the amateurs: the risk and money management protocol. This section is sacred. It is never ever violated. First, position sizing. Your plan must state, in no uncertain terms, the maximum percentage of your account capital you will risk on any single trade. A common model observed in many case studies is between 1% and 2% of the account balance. If you have a $10,000 account, a 1% risk rule means you cannot lose more than $100 on a single trade. This isn't just about one trade, it's about survival. By risking a small percentage, you ensure that even a string of 5, 6, or even 10 consecutive losses, which will happen to every trader, cannot wipe you out. It guarantees you can stay in the game long enough for your edge to play out. Next, the plan dictates your stop-loss strategy. Your stop-loss is not just a random number. It's a strategic invalidation point. It's the price level at which your original trade idea is proven wrong. Your plan must define how you determine this level before you enter the trade. Will it be placed a certain number of pips below the low of the setup candle? Will you use a volatility measure like a multiple of the average true range to place it outside the normal market noise? The method is less important than the consistency. The stop-loss is placed at the time of entry and, for most professional strategies, is not touched or moved further away, ever. Equally important is the take-profit strategy. How will you exit a winning trade to realize your profits? Hoping for a home run on every trade is a recipe for disaster. Your plan needs an exit strategy. It could be a fixed risk-to-reward ratio. For every $1 you risk, you aim to make $2 or $3. So if your stop loss is 50 pips away, your take profit target would be set at 100 or 150 pips away. Another approach could be to exit at a predetermined technical level like a major resistance zone. Some traders use a trailing stop loss that locks in profits as the trade moves in their favor. Again, the key is to define the plan in advance and execute it, without letting greed take over in the heat of the moment. Finally, a comprehensive trading plan includes rules for trade management. What do you do while a trade is open? A common rule might be, once the trade reaches a 1-to-1 risk-to-reward ratio, I will move my stop loss to my entry point. This is called moving to break-even. It takes the risk off the table and turns a good trade into a no-lose scenario. Your plan is your guide for the entire life cycle of a trade, from identification to exit. And here's the secret. This document is not carved in stone. It's a living document. It is constantly refined. How? By using the data from your trade journal, the defensive review we talked about. You execute your plan flawlessly for 20 trades. Then you review the data. Maybe you notice that your setups are more effective during the London session than the Asian session. So you refine your plan. I will only look for setups between 3 a.m. and 11 a.m. Eastern Time. Maybe you notice your 2-to-1 reward target is getting hit consistently, but the 3-to-1 is not. You might test adjusting your plan to take partial profits at 2-to-1. This is the professional feedback loop. Plan, execute, review, refine. It's a continuous cycle of improvement, turning your trading from a series of random bets into a high-performance business operation. It is the ultimate expression of taking control in an environment of uncertainty, and the bedrock of a disciplined mind. And that disciplined mind is tested not in the analysis, but in the fire of an open trade. It's here, in the gap between entry and exit, that the most critical battle is fought. It's not against the market, the brokers, or some shadowy algorithm. It's the battle against the two most destructive forces in a trader's universe: fear and greed. Every successful trader, from the skyscraper offices in Chicago to the home setups in suburban Texas, understands that their long-term survival depends not on their ability to predict the future, but on their ability to manage these two emotions. And the tool they use, the shield that protects their capital and their sanity, is an unwavering, non-negotiable commitment to risk management. To the novice, risk management sounds boring. It sounds like the legal disclaimer at the end of a commercial. It's the brakes on a race car. It's the part they want to skip to get to the good stuff. The entries, the indicators, the secret strategies. But the professional knows the truth. Risk management is the secret strategy. It is the offensive weapon that allows you to stay in the game long enough for your edge to play out. Let's illustrate this with a tale of two traders. We'll call them Mike and Sarah. Both are sharp, both have studied the charts, and both identify the exact same high probability setup on the euro-dollar pair. The analysis is identical, but their approach from this point forward creates two completely different universes of outcomes. Mike sees the setup and his heart starts to pound. This is it. This is the one. All the indicators are aligned, the news sentiment is perfect. He feels it in his gut. So he decides to go big. Instead of his usual position size, he leverages up, risking 20% of his $10,000 account on this single trade. He tells himself, scared money don't make money. He places his entry order, but he sets a very wide stop loss, far away from the current price. He doesn't want to get stopped out by some random spike before the real move happens. The trade immediately goes in his favor. The price shoots up. Within an hour, his account is up 15%. The euphoria is intoxicating. He feels like a genius. He's already mentally spending the profits. But then the market stalls. He begins to pull back. The profit starts to shrink. 10%. 5%. Soon he's back to break even. Panic begins to creep in. No, he thinks. The analysis was right. It's just a pullback. I'll hold. The price drops further. Now he's in the red. It approaches his stop loss. He can't bear the thought of taking a $2,000 loss. So he does the one thing he promised he'd never do. He moves his stop loss further down. He gives the trade more room to breathe. He's no longer trading his plan. He's trading on hope. The market, which has no regard for his hope, continues to slide. The loss grows and his small account is now facing a catastrophic blow. Now let's rewind and look at Sarah, staring at the exact same chart. She sees the same setup and feels the same flicker of excitement. But for her, that feeling is a signal not to jump in, but but to execute her process. Her first thought isn't, how much can I make? It's how much am I willing to lose to find out if I'm right? Her trading plan dictates that she will never risk more than 1% of her account on any single trade. Her account is also $10,000, so her maximum acceptable loss is $100. Period. She identifies the logical place for her stop loss, right below a recent price structure, the point where her trade idea would be clearly invalidated. The distance from her entry to that stop loss is 50 pips. Now she uses that information to calculate her position size. She does the math to figure out exactly how many lots she can trade so that if the price hits her stop loss, she loses exactly $100. Not one penny more. She also identifies her profit target, which is 150 pips away, offering a potential reward 3 times greater than her risk. She places the entry, the stop loss, and the take profit order all at once. And then she walks away. She trusts her plan. Her trade, just like Mike's, initially goes in her favor. Then it pulls back, goes negative. It gets close to her stop loss. Does she feel a pang of anxiety? Of course, she's human. But she doesn't touch it. That $100 loss was accepted before she ever entered the trade. It was a calculated business expense. In her case, let's say the market does reverse and hits her profit target. She makes $300. A solid, disciplined, stress-free win. Or let's say it hits her stop loss. She loses $100. She feels a brief moment of disappointment, jots it down in her journal, and moves on to look for the next opportunity, her capital almost entirely intact. Over the course of a year, Mike experiences a few massive wins that make him feel invincible, followed by soul-crushing losses that wipe out all his gains and more. His equity curve looks like a violent seismograph. He's emotionally exhausted, burned out, and eventually his account is gone. Sarah's journey is different. She has wins and she has losses. In fact, she might even lose more trades than she wins. Let's say her strategy is only correct 40% of the time. But because her winning trades are 3 times the size of her losing trades, the math is overwhelmingly in her favor. For every 10 trades, she might lose 6, costing her $600. But the 4 trades she wins make her $1,200. Her net profit is $600. Her equity curve isn't a dramatic explosion. It's a steady, upward-sloping line. She isn't just surviving. She is thriving. She is running a business. Mike was gambling. This is the core of what separates the pros from the amateurs. The pros have flipped the script. They don't focus on being right. They focus on what happens when they are wrong. That 1% rule is not just a number. It's psychological armor. When you know with absolute certainty that no single trade can ever seriously hurt you, the fear of pulling the trigger vanishes. You can execute your strategy flawlessly, because the outcome of any individual trade becomes irrelevant. And the concept of risk-to-reward ratio is your engine for long-term growth. By only taking trades where the potential gain is a multiple of your potential loss, you stack the odds in your favor. You don't need a crystal ball. You don't need to win 80% of the time. You can be wrong more often than you are right and still build substantial wealth over time. This is the mathematics of professional trading. It's the closest thing to owning the casino. You know you'll pay out on some bets, but over the long run, the house edge ensures you come out ahead. Your positive risk-to-reward ratio is your house edge. So, the successful American trader sees their stop-loss not as a failure, but as an insurance premium. It's the cost of doing business in the most competitive environment on Earth. By predefining their risk, they liberate themselves from the emotional roller coaster of hope, greed, and fear. They transform trading from a stressful, screen-glued obsession into a calm, methodical process of execution. They have mastered the unseen game, understanding that protecting their capital is the only objective that truly matters. Because with capital, you always have another chance. Without it, you're just a spectator. And that spectator role is precisely what separates the hobbyist from the professional. The professional understands that capital is just the entry fee to the game. Winning the game, however, requires a completely different skill set. It requires a habit so fundamental, so unglamorous, that most aspiring traders dismiss it entirely. They're looking for a secret indicator, a magic formula, while the pros are quietly engaging in the most powerful performance-enhancing activity available: meticulous, obsessive, ruthless record-keeping. Think about it. Every elite performer in any field on Earth is obsessed with data. A Major League Baseball pitcher doesn't just remember throwing a good game. He knows his velocity on every pitch, the spin rate, the break of his curveball in the 7th inning versus the first. A Formula One team doesn't just have a fast car. They have terabytes of data on tire degradation, downforce levels at every corner, and engine performance in different atmospheric pressures. They measure everything because what gets measured gets managed, and what gets managed gets improved. Yet in the world of retail forex trading, countless people are piloting a multi-thousand-dollar account based on feelings, on vague memories of what worked last week. They are the CEO of a company, Me Incorporated, and they have absolutely no financial statements, no performance reviews, no data on what products are selling and which are costing them a fortune. They are flying blind and then wonder why they crash. The successful American trader treats their trading not as a hobby, not as a trip to the casino, but as a serious business. And the single most important document in that business is the trading journal. Now, when I say journal, I know what many of you are thinking. You're picturing a diary. Dear diary, today the euro to US dollar was mean to me. That's not it. This isn't a journal of your feelings. Although emotions are a critical data point we'll get to, this is a performance logbook, a ledger of truth. It is the unforgiving mirror that shows you not who you think you are as a trader, but who you actually are. Let me tell you about a trader I know. We'll call him David. David was smart, really smart. He could read a chart like a musician reads a score. He understood market structure. He knew all the candlestick patterns, and he could spot a potential setup from a mile away. And for a while he'd do great. He'd have a week where he'd pull 5, 6, 7% out of the market. He'd feel like a king. And then, in 1 or 2 days, he'd give it all back and then some. It was a brutal cycle of elation and despair. He was convinced the market was out to get him, that his broker was stop hunting, all the classic excuses. His problem wasn't his intelligence, it was his ignorance. He was ignorant of his own patterns of behavior. A mentor finally sat him down and asked him one simple question. Show me your records. David had nothing. Just a brokerage statement with a long list of wins and losses that ended lower than it started. The mentor told him, you don't have a strategy problem. You have a data problem. For the next 60 days, I don't care if you make or lose money. Your only job is to record every single trade in a spreadsheet with excruciating detail. David was skeptical, but he was desperate. So he did it. He built a simple spreadsheet. He logged the date, the currency pair, the entry, the stop, the profit target. The basics. But the mentor pushed him. Not good enough, he said. I want you to add a column for your reason for entry. What was the technical setup? A, B, or C? I want a column for the time of day. I want a column for your emotional state on a scale of 1 to 5 when you entered. And I want you to take a screenshot of the chart the moment you enter the trade and attach it to that row. It was tedious. Felt like homework. It took all the fun out of the gunslinging approach he was used to. But he stuck with it. At the end of 60 days, he had a spreadsheet with over 80 trades logged. He and his mentor sat down to review it. And what he saw, it changed his career forever. The data was screaming at him. The patterns were undeniable. First, he discovered that nearly 70% of his losses occurred on Mondays. He had this psychological need to start the week off with a win. So he was forcing low-probability trades in choppy Monday morning markets. The data proved it was a losing proposition. Rule number 1 was born. No trading on Mondays before the New York Open. Second, he saw that his single biggest losing trades, the account killers, all had something in common. They were almost all taken immediately after another losing trade. He was revenge trading, trying to win back his money from the market, and it was destroying him. Rule number 2. After any losing trade, you must shut down the charts for at least 1 hour. No exceptions. And third, the most powerful insight of all. He looked at the screenshots of his most profitable trades, his A-plus setups, and he saw it. They were almost all identical. A pullback to a key Fibonacci level that coincided with the 200-period moving average on the 1-hour chart. That was his sweet spot. That was his home run pitch. Yet, his own data showed he was only taking that trade about 15% of the time. The rest of the time he was swinging at junk pitches, boredom trades, FOMO trades, hope-based trades. The journal didn't give him a new strategy. It revealed the highly profitable strategy that was already buried beneath the noise of his undisciplined behavior. He stopped being a guy who knew how to read charts and became a specialist who executed 1 or 2 perfect setups. He became a sniper instead of a machine gunner. His trade frequency dropped by 80%, but his profitability soared. He wasn't just guessing anymore. He was running a data-driven business. This is the habit. This is the work that happens when the charts are closed. The successful trader captures reality on paper or in a spreadsheet so they can analyze it objectively. So what goes into a professional trading journal? It has two parts, the quantitative and the qualitative. The quantitative is the easy part. Date, pair, position size, entry price, stop loss, exit price, profit/loss in dollars, profit/loss in pips. This tells you what happened, but the qualitative is where the real gold is. This tells you why it happened. This includes 1. Your rationale. What was the precise, objective reason for entering this trade? It looked like it was going up is not a reason. Price broke and closed above the 4-hour resistance level at 1.2150, and the relative strength index crossed above 50. That is a reason. You must define your setups and tag every trade with the setup name. 2. Your emotional state. Were you calm, focused, and objective? Or were you bored, angry, scared, or greedy? You have to be brutally honest with yourself. This data will reveal how much your emotions are costing you. 3. Your execution grade. Give yourself a letter grade A through F on how well you followed your trading plan. Did you enter at the right spot? Did you set your stop loss where you were supposed to? Did you let the trade play out? Or did you cut it short out of fear? Or worse, did you move your stop loss because you were hoping the trade would turn around? Grading yourself creates a feedback loop for improving discipline. And finally, a screenshot. A picture of the chart at the time of your entry. This is non-negotiable. Months from now, you won't remember the context of a trade. The screenshot provides instant, perfect recall. It allows you to visually review dozens of your wins and losses and burn those successful patterns into your brain. This process transforms you. You stop seeing losses as failures and start seeing them as data points. A losing trade with an A for execution is a good trade. It was simply a case of the probabilities not working out that one time. It was a business expense. But a winning trade where you broke all your rules and got a D for execution? That is your most dangerous trade. The journal exposes this. It shows you that bad habits, even if they occasionally result in a win, will lead to ruin over the long term. The journal is your coach. It's your mentor. It's your business partner who holds you accountable. It is the single greatest tool for accelerating your learning curve. It's the habit that separates the professional who systematically refines their edge from the amateur who is doomed to repeat the same costly mistakes, forever trapped in a cycle of hope and despair, never understanding that the key to unlocking their future was in the data of their past all along. This brings us to the single greatest dividing line in the entire world of trading. It's a concept so fundamental, yet so profoundly misunderstood by the masses, that it almost single-handedly explains why a small fraction of traders find consistent success while the vast majority do not. We're not talking about a secret indicator or a complex algorithm. We're talking about the habit of treating trading not as a hunt for winners, but as a business of managing losers. We're talking about risk management. To the amateur, risk management is a chore. It's the boring part. It's the seatbelt they don't want to wear because they don't plan on crashing. They are obsessed, absolutely fixated on the potential reward. Their entire mental energy is focused on the question, how much money can I make on this trade? They see a setup on the euro to US dollar. Their heart starts to pound. They see the price rocketing to the moon in their mind's eye. They calculate the potential profit, the vacation they could buy, the debt they could pay off. Risk? That's an afterthought. A stop loss is just a suggestion. A pessimistic fallback plan they hope they'll never need. The professional American trader, the one who has survived years in these markets, starts from the exact opposite end of the equation. Their first and most important question is never how much can I make? It is always, how much can I lose? They have internalized a truth that the amateur cannot yet comprehend. You cannot control how much you will make on any given trade. The market will give you what it gives you, but you have absolute 100% control over how much you will lose. And in a game of probabilities and uncertainty, the only thing you can control is the only thing that truly matters. This is the shift from a gambler's mindset to a casino's mindset. A gambler walks into a casino in Las Vegas hoping to hit a jackpot. Their focus is on the win. The casino operator, on the other hand, doesn't care about any single spin of the roulette wheel or any single hand of blackjack. They know they will have losing hands. They expect it. It's a built-in cost of doing business. Their focus is on the mathematical edge that plays out over thousands of hands. They manage their risk so precisely that their survival and profitability are a near statistical certainty over the long run. Successful traders operate their trading account like a casino manager. not a gambler. The cornerstone of this approach is the famous, yet often misapplied, 1% rule. The rule is simple. Never risk more than 1% of your total trading capital on a single trade. If you have a $10,000 account, your maximum acceptable loss on any one idea is $100. Period. No exceptions. No, this one looks really good justifications. The amateur hears this and scoffs. $100. What can I do with that? I'm here to make real money. But the professional understands the profound mathematical power locked within this simple rule. Risking 1% means you would need to have 100 consecutive losing trades to blow up your account. 100. The odds of even a coin flip coming up heads 100 times in a row are astronomically small. This rule is not about limiting your upside. It's about guaranteeing your survival. It ensures that you can withstand the inevitable losing streaks that the market will throw at every single trader, no matter how skilled. It keeps you in the game long enough for your edge, your strategy, to actually play out. Think of your trading capital like a battleship. The amateur's battleship has one giant, open hull, one well-placed torpedo, one unexpected market event, and the whole thing floods and sinks to the bottom of the ocean. The professional's battleship, however, is built with hundreds of small, watertight compartments. If one compartment gets hit, one losing trade, they seal it off. The ship takes on a little water, but it remains fully operational, ready for the next battle. The 1% rule builds those watertight compartments into your financial vessel. But defense alone doesn't win the war. This is where the second pillar of professional risk management comes in: asymmetric risk to reward. This simply means that the potential reward on a trade must be a multiple of the potential risk. The most common standard is a 1-to-3 risk to reward ratio. This means for every $1 you are willing to risk, you are aiming to make at least $3 in profit. Now let's combine these two concepts and see the magic. You have a $10,000 account. You risk 1%, which is $100. You only take trades where your potential profit is at least $300. Look what this does to the math. With this structure, you can be wrong far more often than you are right and still be profitable. Let's say you make 10 trades. You lose 7 of them. 7. That's a 70% failure rate. The amateur would be emotionally crushed, convinced their strategy is worthless. But let's do the math for the professional. 7 losing trades at $100 each is a $700 loss. 3 winning trades at $300 each is a $900 gain. After being wrong on 70% of your trades, you are still up $200. This is the holy grail. This is the math that separates those who last from those who don't. It completely reframes the objective. The goal is not to be right all the time. The goal is to have a system where your wins are mathematically more significant than your losses. It's the financial equivalent of a baseball slugger who strikes out a lot, but when he connects, he hits home runs. A few home runs can win the game, paying for all the strikeouts along the way. This leads to the practical application: position sizing. The amateur picks a random lot size. It just feels right. The professional uses math. They know their entry point and they know their stop loss, the point where their trade idea is proven invalid. Let's say that distance is 50 pips. They know their maximum risk is $100. They simply divide the risk in dollars by the risk in pips to determine the correct position size. This calculation is done on every single trade without fail. It ensures that whether the stop loss is 20 pips away or 100 pips away, the total amount of money they stand to lose remains the same: 1%. This mechanical, non-negotiable approach to risk does something incredible for the trader's psychology. It drains the emotion out of the act of trading. When you know with absolute certainty what your maximum loss is before you even click the buy or sell button, the fear subsides. The trade is no longer a source of anxiety. It's simply a business proposition with a known, acceptable cost. You are no longer praying for a trade to work out. You have defined your terms of engagement with the market. You are saying, I am willing to risk this much to see if my hypothesis is correct. If it is not, I will be taken out of the market with a small manageable loss, and I will move on to the next opportunity, no harm done. This habit is the ultimate defense against the two account-killing demons: fear and greed. It prevents you from taking on massive size after a big win, feeling invincible. And it prevents you from revenge trading with a huge position after a loss, desperate to make your money back. The rules are the rules. The math is the math. It is the unwavering discipline to this framework that forms the bedrock of a long-term trading career. Successful American traders, many of whom come from backgrounds in engineering, business, or even professional poker, see this not as a limitation but as liberation. They understand that by strictly controlling their downside, they liberate their upside. By focusing on capital preservation above all else, they give their winning trades the room and time they need to develop. They are not just trading a currency pair, they are managing a portfolio of probabilities. Their success isn't built on a few legendary wins they brag about, but on the disciplined and relentless management of thousands of small, insignificant, and painless losses. But having these mathematical rules is one thing, having the ironclad mental fortitude to follow them, day in and day out, through the euphoria of winning streaks and the despair of losing streaks, that is an entirely different war, fought not on the charts but in the 6 inches between your ears. And this is where the majority of aspiring traders meet their end. Not because their strategy was flawed, not because their analysis was wrong, but because they lost that internal war. They had the roadmap, but they let their emotions hijack the driver's seat and steer them right off a cliff. Think of it like this: you can give 2 people the exact same high-performance race car. One is a professional driver, calm, collected, focused only on the track, the apex of the next turn, the feedback from the tires. The other is a novice, white-knuckled, heart-pounding, eyes darting between the speedometer and the roaring engine of the car next to them. They have the same machine, the same potential. But who is more likely to finish the race, let alone win it? The one who has mastered their inner state. In the world of trading, this mastery boils down to conquering 2 ancient, powerful, and relentless beasts that live inside every single one of us: fear and greed. They are the twin sirens luring traders onto the rocks of financial ruin. Let's talk about fear first. Fear in trading wears many masks. There's the most obvious one, the fear of losing money. This fear can be so paralyzing that a trader sees a perfect A+ setup, one that fits every single rule in their trading plan, and they just freeze. Their finger hovers over the mouse, but they can't click it. Their mind races with, what if I'm wrong? What if this is the one time it doesn't work? And so they do nothing. They watch as the trade plays out perfectly without them, leading to immense regret, which then fuels their next mistake. Then there's its cunning cousin, the fear of missing out, or FOMO. This is the fear that whispers in your ear when you see a currency pair like the euro/dollar suddenly rocketing upwards. You didn't plan for this trade, it doesn't meet your criteria. But you see the green candles stacking up and you think, everyone else is making money. I have to get in. So you jump in at the top just as the early buyers are taking their profits, and you're left holding the bag as the price comes crashing back down. FOMO is a fear of being left behind, and it's responsible for more blown accounts than perhaps any other single emotion. Consider the story of a trader we'll call Ethan from Austin, Texas. Ethan was brilliant. He backtested a system on the pound sterling to Japanese yen pair for months. The historical data was clear. His system had a positive expectancy, but when he went live he kept losing. Why? His journal revealed the pattern. After a losing trade, the fear of being wrong again would grip him. He'd see his next valid setup, and he'd hesitate, waiting for extra confirmation. By the time he felt safe enough to enter, the best part of the move was already over, and his risk-to-reward ratio was ruined. He was letting the ghost of his last trade haunt his next one. Fear wasn't just making him uncomfortable. It was systematically destroying the profitable edge of his well-researched system. And on the other side of this emotional coin you have greed. If fear is the paralysis of inaction, greed is the recklessness of overaction. Greed is that voice that tells you, this trade is a sure thing. Forget your 1% risk rule, put 10% on this one. Let's make this month's mortgage payment in one shot. Greed is what convinces a trader to double down on a losing position, averaging down in the vain hope that it will turn around, transforming a small, manageable loss into a catastrophic one. Greed also shows up in a more subtle way. It's what prevents you from taking profit when your target is hit. Your plan says to exit here, but the price is still moving in your favor. Greed whispers, just a little more. This could be the big one. So you hold on and you watch your healthy profit shrink, then vanish, and then turn into a loss. You turned a textbook winning trade into a losing one, not because of the market, but because of an insatiable desire for more. A trader from Miami, let's call her Sarah, learned this the hard way. She had a phenomenal 2-week winning streak. She felt invincible, like she had a crystal ball. Her confidence morphed into arrogance, and arrogance into pure greed. She started increasing her position size with every win. She abandoned her carefully crafted rules for risk management, believing she simply couldn't lose. Then came one trade. It went against her. Instead of accepting the small loss, her ego, fueled by greed, couldn't take the hit. "It'll come back," she told herself. She held on. The loss grew. She moved her stop-loss further away, giving the trade more room to breathe. But the trade was suffocating her account. In less than 48 hours, a single greed-fueled trade wiped out not only her entire 2-week winning streak, but her initial capital as well. She didn't lose to the market. She lost to herself. So if both fear and greed are so destructive, what is the habit of the successful American trader? It's not that they don't feel these emotions. They absolutely do. They are human. The key habit is the development of disciplined, detached execution. They have trained themselves to act as the impartial executor of their trading plan, regardless of the emotional storm raging inside them. They are the surgeon focusing on the procedure, not the patient's potential outcome. They are the pilot, running the checklist, not worrying about the storm clouds on the horizon. How do they build this mental fortress? It's not magic. It's a series of deliberate practice techniques. First, they use their trading journal as a psychological mirror. They don't just log their entry price, stop loss, and take profit. They log their emotional state. Why did I take this trade? Was I feeling anxious? Was I feeling greedy after my last win? Did I hesitate? By writing it down, they drag the emotion out of their subconscious and into the light of day where it can be analyzed objectively. Over time, they see patterns. I noticed that after 3 winning trades in a row, I almost always break my rules on the 4th one. This awareness is the first step toward control. Second, many top traders practice mindfulness. This isn't about sitting in a lotus position for hours. It's about the practice of being present. When they're analyzing a chart, they are only analyzing the chart. They aren't thinking about the loss they took yesterday or the money they hope to make tomorrow. Mindfulness trains the brain to recognize an emotion like fear or greed as it arises, to observe it without judgment, and crucially, without acting on it. It creates a small gap between the emotional impulse and the physical action of clicking the mouse. In that gap lies the power of choice. Third, they conduct what's known as a pre-mortem on every single trade. Before they enter, they fully and completely accept the risk. They don't just set a stop-loss. They visualize the trade hitting that stop-loss and losing the predetermined amount of money. They say to themselves, "I am risking this X amount, and I am 100% okay with losing it if this trade doesn't work out." This is the cost of doing business. By pre-accepting the worst-case scenario within their plan, they strip the loss of its emotional power. When you truly don't fear the loss, you can execute your plan without hesitation. And this all ties into the ultimate psychological shift that defines the professional trader. They focus relentlessly on the process, not the profits. A novice trader judges their day by whether they were green or red. A professional trader judges their day by one, and only one criterion. Did I follow my plan flawlessly? They know with absolute certainty that they cannot control the outcome of any individual trade. The market is a sea of probabilities, not certainties. But they can control their actions. They can control their analysis, their risk management, and their execution. Their job is not to be right. Their job is to execute their edge over and over again. If they do that, the statistical probabilities that underpin their strategy will take care of the profits over the long run. They derive their satisfaction not from a winning trade, but from a well-executed trade, win or lose. This shift from an outcome orientation to a process orientation is the final key that unlocks the door to emotional detachment and, ultimately, to consistent performance in the unforgiving arena of the markets. It's the difference between gambling and operating a business. And if you're operating a business, you don't just show up, throw money at something and hope for the best. A real business has systems. It has accounting. It has performance reviews. This is where we separate the professionals from the hobbyists. This brings us to the next critical habit of America's most successful Forex traders. They are obsessive, almost pathologically meticulous record keepers. I'm not just talking about the automatic trade log your broker provides. That's just raw data. That's like a CEO only looking at the final bank balance without reading the profit and loss statement, the balance sheet, or the cash flow analysis. The pro trader maintains a detailed journal, a trading diary that goes far beyond the numbers. This journal is their single most important tool for growth. It is their game film. It is the black box from a crashed airplane that tells them exactly what went wrong, or what went right. What do they record? Everything. The date, the currency pair, the position size, the entry price, the stop loss, the take profit target, and the final profit or loss. That's the basic stuff. Here's where the magic happens. They also record why. What was the setup? Was it a technical pattern, a fundamental catalyst, a specific indicator alignment? They will literally take a screenshot of the chart at the moment of entry and annotate it, drawing the trend lines, support levels, and indicators that form their thesis. They are building a case file for every single trade. But they go even deeper. They record their emotional state. Were they feeling confident, fearful, greedy, or bored? Were they chasing a loss from the previous trade? Were they feeling overconfident after a winning streak? They write it all down with ruthless honesty, because they understand that in trading, you are not just battling the market. You are battling yourself. Your emotions are data points. They are leading indicators of potential mistakes. Let me tell you about a trader. We'll call him James from Chicago. James was smart, he'd read all the books, and he had a decent strategy. But he was stuck in a boom and bust cycle. He'd make $5,000 in a week, feel like a king, and then give it all back plus some the next week. He was on the verge of quitting, convinced the game was rigged. His mentor asked to see his trade journal. James sheepishly admitted he didn't keep one. He kept it all in his head. His mentor gave him an ultimatum. Keep a detailed journal for 1 month, tracking everything I just described, or I can't help you. Reluctantly, James agreed. At the end of the month, they sat down to review it. The pattern was blindingly obvious. His winning trades were almost all executed between 9 a.m. and 11 a.m. Eastern. They followed his plan perfectly, and his journal notes for them read calm, focused, clear setup. His losing trades, however, were a disaster. They were clustered in the late afternoon. They were often on pairs he didn't normally trade. And his emotional notes were filled with words like bored, trying to make something happen, revenge trading after that small loss. The journal didn't lie. It wasn't the market that was beating him. It was James, the bored, impulsive afternoon trader, who was sabotaging James, the disciplined, focused morning trader. The journal allowed him to see he wasn't one trader. He was two. And his job was to fire the bad one. That insight, made possible only through meticulous record-keeping, changed his entire career. This leads directly to the next habit, which is inseparable from the first: the non-negotiable weekly review. A journal is useless if it just collects dust. The data has to be analyzed. So every weekend, typically on a Saturday or Sunday when the markets are closed and the emotional heat of the week has cooled, the professional trader becomes a forensic investigator. They open up their journal and they perform an audit. They become the CEO of You Incorporated, holding a performance review with their only employee, themselves. They aren't just looking at the wins and losses. They are looking for patterns. They categorize every trade. Was it an A+ setup, where every single one of their rules was met? Was it a B setup, where most were met but one or two were a bit fuzzy? Or was it a C or F trade? A complete breakdown in discipline, an emotional impulse? They find that very often, if they could just eliminate the F trades, the revenge trades, the boredom trades, they would be consistently profitable. The review process shines a harsh, undeniable light on these self-inflicted wounds. They ask hard questions. Did I follow my plan on every single trade? If not, why? Did I cut my winners short out of fear? Did I let my losers run, hoping they would turn around? Is my stop-loss placement effective? Or am I getting wicked out of good trades too often? Is there a certain day of the week or time of day where I consistently underperform? Just like James from Chicago, they identify their kryptonite. This weekly review isn't about beating themselves up. It's about objective, dispassionate analysis aimed at one thing: incremental improvement. A 1% improvement every week. They are looking for their strengths to double down on, and their weaknesses to eliminate. They might discover that 80% of their profits come from just 2 specific trade setups. The logical conclusion: stop taking the other, lower probability setups and wait patiently for their bread and butter. This process of review and refinement is how a trader hones their edge to a razor's sharpness over time. This constant feedback loop of journaling and reviewing fuels the final habit in this section: radical adaptation. The professional trader knows the market is not a static entity. It's a living, breathing, constantly evolving ecosystem. A strategy that crushes it in a high volatility, trending market might get chopped to pieces in a low volatility, range-bound market. The one-trick pony traders are the ones who have a great year and then disappear. The elite trader, however, is not married to a strategy. They are married to their process. Their process of journaling and reviewing acts as an early warning system. Through their weekly audit, they might notice that their classic breakout strategy has stopped working as effectively over the past month. The win rate is dropping. The follow-through is weak. Instead of getting angry and trying to force it, they see this as a data point. The market is telling them something. Its behavior has shifted. So they adapt. They might reduce their position size. They might start looking for range-based setups instead. They might decide to sit on their hands and wait for volatility to return. They don't predict the future. They react to the present reality as shown to them by their own performance data. Their loyalty is not to a single indicator or pattern. Their loyalty is to their bottom line and their capital preservation. This ability to be flexible, to pivot based on hard evidence from their own trading, is what ensures their longevity. They survive market shifts that wipe out rigid, dogmatic traders. This entire system, the meticulous journal, the uncompromising weekly review, and the commitment to adaptation, is what transforms trading from a gut feel gamble into a high-performance profession. It's how they build a fortress of logic and process around the volatile core of human emotion. It's how they systematically improve, refine their edge, and stay in the game long enough for that edge to play out. They are, in essence, their own trading coach, using their own history as the ultimate textbook. But even with this entire system in place, there is one final overarching mindset, one core belief that holds it all together. It's the habit that governs their relationship with risk, with uncertainty, and with the very nature of probability itself. It's the final and perhaps most misunderstood habit that we will break down next. And that habit is the complete and total acceptance of a probabilistic mindset. It sounds academic, but it's the most fundamental shift a trader can ever make. The amateur trader, even one with a good strategy, lives in a world of absolutes. They place a trade and in their mind, it's either a good trade that's going to win, or a bad trade that's going to lose. Their emotional state is directly tied to the outcome of that single event. If it wins, they feel like a genius. If it loses, they feel like a failure and they question everything. The professional trader doesn't live in that world. They live in a world of statistics and edges. They understand that on any given trade, the outcome is essentially random. Anything can happen. A news event can drop, a whale can enter the market, a pattern can fail for no apparent reason. They don't try to predict the outcome of a single trade. It's a fool's errand. Instead, they focus on one thing and one thing only. Does my strategy have a positive expectancy over a large series of trades? Think of it like a casino. The casino owner doesn't stand over the blackjack table sweating every hand. He doesn't care if one player hits a lucky streak and wins 10 hands in a row. He doesn't celebrate when another player busts out. Why? Because he knows that over thousands and thousands of hands, the house edge, a small statistical advantage of just a couple of percent, will play out. The law of large numbers is on his side. His profit is a mathematical certainty over time, even though the outcome of any single hand is completely uncertain. Successful traders learn to operate their business like the casino, not like the gambler hoping for a lucky hand. Their trading plan is their house edge. They've back-tested it, they've forward-tested it, and they know that if they execute it flawlessly 100 times, the statistical probability is in their favor. Let me tell you about a trader I know from Chicago. Let's call him David. David was smart, driven, and had a solid technical strategy, but he was stuck in a vicious boom and bust cycle. He'd follow his rules for a week, make a few $1,000s, and feel invincible. Then, convinced he had the Midas touch, he'd see a setup that was almost perfect, bend his rules just a little, and take a much bigger position because he was so sure it was a guaranteed winner. Of course, that trade would often be the one that went against him, wiping out his entire week of disciplined work. Crushed, he'd then go to the other extreme. He'd take a few small losses in a row, perfectly normal for his strategy, and become convinced his system was broken. He'd panic, start tweaking his indicators, jumping to a new strategy he saw online, searching for the holy grail that never loses. He was on a constant, exhausting emotional roller coaster, driven by the outcome of his last trade. His mentor, a quiet, old-school commodities trader, saw his struggle. One day, he didn't talk about charts or indicators. He handed David a quarter and a notepad. He said, "I want you to go home and flip this coin 200 times. Every time it's heads, you write down plus $2. Every time it's tails, you write down minus $1. Don't stop until you've done it 200 times. David thought it was a ridiculous waste of time, but he respected the man, so he did it. The first 10 flips, he got 7 tails. He was already down. He felt that familiar frustration. Then he hit a streak of heads. He felt a rush of excitement. He saw long choppy periods where he went nowhere. He saw streaks of losses and streaks of wins. The experience perfectly mirrored the emotional journey of his trading. But when he finished all 200 flips and tallied the results, he was up significantly. He came back to his mentor the next day, and the old man just smiled. "Your job," he said, "is not to guess the next flip. Your job is to know you're flipping a weighted coin and to just keep flipping. Your strategy is your weighted coin. The market will provide the randomness. You just have to provide the discipline to execute." That single exercise changed everything for David. He stopped seeing losses as failures. They were just tails. They were a normal, expected part of the business. He stopped seeing wins as a sign of his genius. They were just heads. He finally understood that his only job was to show up every day and methodically execute his edge, to be the casino. His focus shifted from the outcome of any single trade to the quality of his execution over hundreds of trades. And that is when he finally achieved consistent profitability. This probabilistic mindset is the final glue that holds all the other habits together. It's what allows you to manage risk properly, because you know losses are inevitable. It's what gives you the patience to wait for A-plus setups, because you're not desperate to win the next trade. It's what allows you to be emotionally detached, because you're not riding the highs and lows of each outcome. You're simply a professional, executing a business plan. So as we bring this journey to a close, let's see how it all connects. This isn't a list of 10 separate tips. It's a blueprint for building a single, cohesive professional identity. You start with a disciplined routine, preparing your mind and your workspace for the battlefield. You then operate from a meticulously crafted trading plan you're mapped through the chaos. You protect your capital with non-negotiable risk management, ensuring you can survive to trade another day. You track every action in a detailed journal, creating the data that proves your edge. You exercise profound patience, letting the market come to you, never forcing your will upon it. You cultivate emotional detachment, viewing trades as business transactions, not personal referendums on your self-worth. You commit to being a lifelong student of the markets, knowing that your education is never complete. You build a foundation of physical and mental resilience, because trading is a performance sport that demands you be at your best. You religiously follow your process because you know that a sound process is the only thing that leads to sound outcomes over time. And you wrap all of it in the understanding that you are a probability manager. You are not a fortune teller. You are the house. The path of a top trader is not a get-rich-quick scheme. It is a get-rich-slow process. It's about building a fortress of powerful, positive habits, brick by brick, day by day, until your discipline becomes so reflexive that it's simply who you are. It's about falling in love with the process, not the potential profits. The money is simply a byproduct of consistent, professional execution. The real prize is the person you have to become to achieve it. Disciplined, patient, resilient, and objective. The journey to becoming a consistently successful trader is one of the most challenging personal development quests you can undertake. But the skills you forge along the way, the emotional control, the discipline, the analytical thinking, will serve you not just in the markets but in every single aspect of your life. This is the path. These are the habits. The question now is not whether they work, but whether you are willing to do the work to make them your own.